Good afternoon. Hopefully you can hear me. My name's Ian Powell, Managing Director of the Dairy Group. Topic this last session is about costs. Costs, no doubts, if you're dairy farmers, are terribly important. We've just finished our cost exercise for the last financial year. Average cost around 44 pence. Forecast for the current year is about 43 pence a litre. So a bit of a salutary lesson. Milk price currently stands about 40 pence a litre. So costs, can't hear, apologise. Failed already. Cost reduction, big issue for all dairy farmers. Currently we're probably offering close to break even. So for most farmers it's going to be another challenging year. We have 4 panellists. I'll ask them to introduce themselves, starting with Matt.
Can you hear me okay? Yeah, very good. Good afternoon, everyone. My name is Matt Ryan. I am the Head of Farmer Relationships for Oxbury Bank, which is a bank we've been operating since the start of 2021. Originally from New Zealand, you probably can't tell, and I'm been financing dairy farms and various farming businesses since about 2005.
Elizabeth?
Yeah, good afternoon. My name's Elizabeth. I originate from Essex, from an arable farming background. I moved into the dairy sector about 15 years ago, and I've worked in fresh veg and fruit as well on the East Coast, and I've been practicing on my own for about 25 years.
Paul?
Good afternoon, everyone. It's Paul Blundell from HSBC. I'm a relationship director covering the southwest of England, looking after a lot of large dairy farms as well as other businesses across the agricultural sector.
And after you, Roy.
I'm Roy Jackson. I'm one of the partners at WR Partners. So I specialise in the rural sector. So we look after many farming businesses, essentially in the northwest, in Wales and the Midlands. Varying in size, and in dairy sector, arable cereals, and across into broilers and eggs.
Okay, thank you, panellists. The session will run with roughly 4 to 5 questions. I'll pose those questions and then ask the panel to give their views, and then we'll see whether we open those up to some questions as we run along. So the first question I have is, what common opportunities are available to dairy farmers in their pursuit of profitable enterprise? So perhaps start with Matt, and then we'll work right to left, if that's okay.
I mean, these are pretty broad questions, aren't they? So you're probably going to get an equally as broad sort of answer out of me. So I mean, what's available? So I mean, if I take a bit of a step back and I look at put my global kind of hat on, one thing that UK farmers must never forget is what diversification options that you have here that other farmers around the world just do not have, right? If you look at an acre of land in, Warrnambool in Australia, Canterbury Plains, the Waikato, whatever, there's very little you can do with that apart from run, about 2.5 jerseys per hectare or 3.5 Holsteins if you're down in the South Island or whatever. Whereas here you can put on commercial lets, you can do all these other different income streams and bring it in through non-farm income. It can flatten out your cash flow and actually de-risk your business, right? So the UK's in a really sort of unique space here where you've got 70 odd million people on this island all wanting commercial space and food. So there's various value add options and other ways you can kind of utilise your space outside of running a really, really efficient dairy farm, of course.
Thanks, Matt. Elizabeth?
Okay, so I come from probably a completely business immersed point of view, and very practical. So for me, the cornerstone is planning and monitoring. The opportunities that we've got now is much more automation, much more opportunity to use the software that is being developed day in, day out, and it's becoming much easier for everybody to do. My last point is that business structuring and planning is always free, apart from your time. So those are common opportunities that everybody's got.
Okay, thanks, Liz. And Roy, if you're happy next.
Yeah, I think as Matt said, there's actually probably quite a variety of actually opportunities out there, and these are very broad examples, so there's no one size that fits all in any way. I guess probably in terms of those businesses which we see are going in the right direction in terms of their profitability, we're probably seeing in terms of that access to land and buildings, they're making sure they've got really good solid foundations in terms of taking their business forward. That does enable them to plan and actually take it in the right direction. And I think as well what we're seeing as well is across the board, like everyone in here, is probably an increase in overhead cost per pence per litre or whatever sector you're in terms of farming, that overhead cost is increasing. So actually in terms of what you can do in terms of collaboration, or whether it's contracts or whether sharing machinery, whatever that might be, but actually how can you spread that cost across I guess probably a broader spectrum to bring that cost per litre down.
I don't want to repeat what's been said, but I probably agree with everything that has been said. To add to it, I think we look at the successful businesses that we look after, the successful dairy businesses, and we see a long-term strategy in place. We see a plan as to where the business is going, and behind that plan then becomes the investment that follows that. So the investments that's required to essentially help people to achieve what they're looking to get. If that initial strategy isn't there, then it can be a little bit, there'll be some that do okay, there's some that don't do as well. But say understanding where they want to get to and having a plan to get there is actually, really crucial, because there's plenty of opportunity out there, and we've touched on a few already. I might throw another couple in myself in a moment, but without surrounding yourself with advisors, working with your family, understanding exactly where you want the business to go to, it's going to be a little bit rudderless, and you might not achieve what you could achieve from your farm without having that true vision. The other couple of things, I suppose, more operational, if you like, that I was going to throw in. We've talked for a long time, and I'll continue to talk about people maximising their milk contract. So understanding the constituents that are in that milk contract and really maximising your operation and performance around what that milk contract provides for you. And then, say, it's also being open to the new things that are coming. So obviously, SFI at the moment is very much the not flavour of the month, but it's new to us as a business, to an industry, and it's understanding, what can that do for you, and how you can maximise the outputs from that as well. So just some thoughts there.
Thanks, Paul. We have time for a couple of questions if anybody's got one they'd like to ask at this point. Nope.
Areas in New Zealand?
So just to clear a couple of things up, so we're a UK bank. You probably haven't heard of us. We've got a UK banking license, not a New Zealand-based one. I'm just New Zealand sounding that works for them. But in terms of back there, look, there's some very small. So a classic diversification that I used to deal with was sheep and cattle farmers on a coastal peninsula in New Zealand that would have a whole load of mussel boys. We'll be selling greenlet mussels and exporting them straight to Asia, and they'd do a little bit of aquaculture, salmon farming, and a few other things like that. And then a little bit like what's going on down in Kent, we started putting in Sauvignon Blanc and Pinot Noir on the warm-facing slopes with irrigation, probably about at least 35 years ago. So that's been happening. So the wine industry back there is probably more of a reflection of low sheep and beef returns on marginal land in places like that. So yeah, a couple of big broad examples there, but certainly no one milks cows down there and has their own milk run into places in Kent like they do here. The tourism thing's very, very difficult because you're generally off the beaten track, and your value add options from the produce that you produce on farm virtually non-existent.
Okay, move on to a second question. What factors do you see emerging as consistent among the most financially resilient dairy farms? Perhaps start with Paul this time, work left to right.
Thank you. It's going to be quite general, but scale in one word. And scale doesn't just happen. Scale comes, going back to my previous answer, I suppose, with strategy, but significant investment. But the farmers that have invested, if I look over the last 10 years, those that have invested to be, what I would call, very large herds, so 1,000 plus. Yes, they're carrying the debt that goes with that, but they have the ability to look at economies of scale, so spread their overheads across the cost of the whole herd, of the whole business, and even when milk price isn't where they maybe would like it to be, that there is still a margin there in those businesses that have invested and have got a stable, large herd. So the one prevailing factor over anything that I see is scale. Now, that's not to say that a well-run small farm with minimal debt can't make good money as well, because we do also see that. But if we're looking for a pattern and the way that we see the business moving, where we're, let's say, lending the most money, putting them in the most investment, it is around that scale side.
I think really quite a few of the actual factors that we talked about actually here are probably in terms of actually those, what we talked about earlier on in terms of those opportunities. So I think probably talking about Paul's point really is actually in terms of the investment. So actually those businesses which are most resilient, they have invested and they continue to invest to make sure they retain up-to-date equipment and also retention of data so they can make the right decisions. I think there can be a sort of a scattergun approach occasionally, and probably those most resilient businesses, they focus on the most important decision making and key performance aspects of their business, so those things that actually drive their profitability. I think probably one other thing really, I think we've seen a huge issue in terms of actually energy, so those resilient businesses, they're investing in renewables, so that actually they're not so actually going forward so susceptible to those energy price spikes, so investing in those renewable areas.
Thanks, Roy. Elizabeth, are you next?
Yes, so I've broken it into 4 parts. Firstly, and in order, I'd say firstly, it's the communication between stakeholders, firstly with partners and directors, and then filtering down to banks, partners and shareholders. I think that comes across to me whenever I'm going into larger businesses where they can communicate effectively within and without. Speed of reaction to opportunities and threats, being able to invest and plan purchases and all the changing legislation as quickly as possible. And then thirdly, I think that reforecasting to me is extremely important, not just relying on one annual budget. Things change quickly and financially resilient farms know that, and they look at things on a day-by-day, month-by-month basis. And lastly, not to overcomplicate matters.
I'd probably concur completely with Elizabeth there, but I suppose one thing I have observed with the most sort of financially resilient farmers is they control what they can control, first and foremost. Look at farming, there's so much outside of our control here. You've got these crazy, oddly functioning global commodity markets that none of us can influence at all. And if you look at milk powder in particular, that's the one I've sort of been watching quite closely, certainly in my career. It usually works in 8-year cycles, right? Oddly enough. If you look about every 8 years, there's been an upturn or a downturn. So you've got to factor that into your thinking. And more, just as important, if you're a bank, you've got to factor that in as well. Because sometimes banks can break ranks, so to speak, in the good years and lend too much and take the umbrella away when it starts raining, so to speak. So controlling what you can control is really important, and price to a point you can't really control. But there's other things that you can do. Focus on a cost of production. If every dairy farmer on our books just focused on cost of production and actually nailed down how much it costs to produce a litre of milk, it'd be interesting to see what happened when we went into the next downturn. So that's a real easy one. The other one is focus on a per cow profit. So some of the best ones we're doing are about £1,000 per cow profit. That's quite a good whole farm kind of a view. Certainly, I know if there's someone from Kite here, they'll probably be nodding. Probably not. And there's other little ones like there's a high correlation with financially resilient farmers and regularly high in-calf rates of their cows. It's just a real simple one that we've seen over the years. So, anyway.
Okay, thank you for your response. Have a question at the back there, please. Roving mic on its way.
Hi, it was just really, could you define what you mean by scale? When you say scale, how big is scale? And does it mean more cows? Does it mean more land? Does it mean more machinery? Does it mean diversification? And is that more attractive to a bank scale than the sort of more traditional family-run business?
Scale. I suppose when I was giving you my answer, I was thinking cows, but with cows, you need the land or access to the feed, and you then need more machinery to farm that land. So it's probably all of the above. In truth, in this, if you have that view that you want to sort of milk a high number of cows, you need that infrastructure and support around the business to be able to do so. You can't simply just say, oh well, I can buy a large dairy or build a large dairy, stick a rotary in there, and I'm done. Because actually, if you haven't got the land, if you don't have the support, the staff, the machinery, it doesn't work. So it is all of the above, and so it's not a decision to be taken lightly. Just think, oh well, I'll get more cows and that'll be better, because it's all the pieces of the jigsaw need to fit in order for that to be successful. Is that more attractive to us as banks? In most cases, businesses that do that have the right levels of support. They've got the key people in the right place in that business. So be that running the herd, running the office, running the strategy. Have they got a good accountant? Have they got a good consultant? We tend to see businesses that have scale have that sort of infrastructure, those sort of people around the business, which again gives us comfort that actually we're not reliant on one or two people for this business to succeed or fail. They've got support, they're taking advice, which is hugely valuable to us. I'm not saying that's exclusively all we want, but they tend to be the traits that we will see in a scale business, and that's quite attractive to a lender. It gives us a lot more comfort when we're putting large sums of money out the door that actually this is a business that's extremely well advised and as I'll go back to my first answer again, has got that strategy as to what they want to do. Now, can you do that with 250 cows? Yes, you can. And it's not that we wouldn't look to sort of fund a smaller dairy. It's just, I say, when we're looking at those larger proposals, if you like, they're the extra bits that we would expect to see.
Thank you, Paul. Anybody else on scale before we pick up another question? No?
Not on scale.
No, far away.
Okay, following up on Matt's point about focus on what you can control. Given the average dairy farmer is head down, bum up, how can we help them as an industry, as a supply chain, to lift their head and look for what they can control?
Yeah, I think it's a really good point, and I suppose it's always a good place to start with just reminding them what they can't control. And you can't control the weather, you can't control commodity prices. You can't control life events and key staff members' lives that happen from time to time. But there are certain strategies and certain practices that some of these farmers can have, which is doing recruitment a little bit and often, not when it's needed for a start. A lot of them have, reliance on a lot of sort of rented land to grow more maize and do those kind of things. So that's obviously a strategy to control their own feed a lot better. There are various different things that they can do around. There'll be milk futures and whatnot will come commonplace sort of one day. So that may become front and centre of certainly some of the larger dairy farmers, which could help give a bit of price certainty. So, but yeah, it's definitely it's starting and reminding them what they can't control, and that will probably go quite some way, I'd imagine.
Okay, thank you, Matt. Okay, we'll move on to another topic area. I'm going to skip the one that you think you're getting to one about net zero. This morning, NFU talked about their achievement of net zero by 2040. I think they've written that off now. And they're actually asking for the agriculture budget to be increased by 50%. I think possibly trying to get in there or early, because the Labour government's probably going to cut the agriculture budgets. So the suggestion is, how can agriculture achieve net zero without support from government? That's not the question. The question is to the panellists, how do you evaluate the importance in ensuring net zero strategy and awareness of sustainability requirements? I think it's you again, Matt.
Okay,
Going
yeah.
right to left.
Yeah, look, we were talking about this actually at a kite conference, was it last week? And certainly from a banking point of view, where we are heading as an industry, definitely because we are mandated to by the Bank of England, is pretty soon. Well, banks are all going to have to be measuring their Scope 3 emissions. So that's the emissions of all of our customers, right? So so this is when stuff like carbon audits become really, really important. That I think the dairy industry is best placed out of any other industry in the UK to kind of get ahead on this. But I suppose the inevitability of where we will end up is the profitability of a farm won't just be the only reason that farmers will get lent money, right? So because there's no point in having a super profitable dairy farm if it's wrecking the environment, if there's slurry pits that are leaking into waterways and all this kind of stuff, right? So we're heading towards a very holistic environmental kind of a financing model, which and we're not yet there, and we won't be there for a while, but it'll certainly be a combination of people, profitability, and environment, which will go into whole loads of things such as deciding availability of capital for who, affordability, and the price of it as well. So that's just a slightly different angle on this net zero and where the incentivisation of it is heading for farmers. And believe it, some of the notes and messages that we get from the Bank of England at Oxbury, they're pretty pointed on this sort of stuff. So, and you will see a lot from probably all of the banks over the next few years doing more in that space.
I think that sustainability of any kind has to start with financial sustainability, and you can't really be green when you're in the red. So having the ability to invest is key. When I'm evaluating a business, I would look at ways to minimise the key finite costs, being energy, power and water. So knowing, well aware of all your different renewal dates that are coming up for tender, and then going into a robust tendering process. And then on the flip side, I'd be looking at income generation to do with biofuel, hydro generation, bioethanol production.
Thank you, Liz. Roy?
I think really just going from Matt's point, the actual drive in terms of net zero is going to be coming from external parts. So whether that be your buyers, whether it be your suppliers, they're going to be driving that by virtue of price if you're not meeting those targets going forward. So I think that's going to be taking that direction. I'm not sure it's going to be government-led as such. We're then seeing actually that alignment essentially in terms of actually whether you're aligned with your actual buyer and your customer suppliers. So actually if you're not aligned with actually what they're intending you to do and actually your systems aren't aligned with that, then you're not going to achieve those targets. And I think one of the most important things actually is actually which measure are you using. There's so many measures out there in terms of actually what net zero looks like. I think the banks are all using different ones, like HSBC, I'm sure Paul will talk about that. They've got a measure. I'm not sure if Oxbury use the same measure, but actually it's being consistent when you're measuring that as well going forward, so you can see where you're going with that. I talked about energy prices going forward as well. That's also to make sure that you're financially in the right footing on that, because I had a client the other day and they're looking to renegotiate their energy bills. It's not necessarily the energy price, it's actually the standing charges. They're the big increases. So the one has actually seen an 800% increase in their standing charge, which is not energy price as such, but it's their standing charge.
I think, as everyone has touched on indirectly, this is a hugely complex area. And to pick up some of what Matt was saying about the requirement of business and finances to sort of be hitting net zero by sort of certain dates. A lot of them 2050 is a date that you'll see. And to Matt's point as well, part of that includes what are our customers doing? Are our customers also net zero? Now, when we look at HSBC, agriculture is a relatively small part of HSBC. The different types of businesses that we fund are wide and varied, and you get into oil and gas and other industries such as that. So at the moment, I would suggest we're in sort of a data gathering phase when we're looking at, what does our portfolio look like, what is our customer base, and accepting that some of those businesses are probably never going to get to net zero. There's certain businesses, what they do, they will not get to net zero. But actually, when we look at a blend of what we have as a whole, are we moving in the right direction? So bringing it back to our agricultural portfolio, internally, we've made an assessment of every single business that we look after around their attitude towards net zero. So there's better phrase than this, but from people who couldn't care less to tree huggers. We got the two ends of the scale, and then people who are on sort of different parts of that journey in between. And we've made an assessment as to where do we think our customers are on that scale. Are they embracing it? Are they interested? Or frankly, do they not really care? And off the back of that, we're, I suppose, starting to formulate what we can do to help support customers, because this is not going away. And so actually, I think we're a long way off this, but there might come a point where actually if you're paying no attention to anything sustainable, you're not doing anything to improve what you do, there might come a point where we say we simply don't want you as our customer anymore. Whereas those that are showing interest, looking, seeing what's out there, wanting to move into different things, we're looking at how can we support people along that journey to get to be a more sustainable farming businesses. And I don't want to use this as a sales pitch at all, but just this week we've introduced what we call the first part of our sustainable farming pathway. We've launched an initiative alongside Leaf around essentially doing audits around how farms are run, and people who are part of that actually are getting preferential terms to their borrowing with the bank. And there's a bit of stick and carrot in there, I suppose, but I think that is a direction of travel, and Leaf certainly won't be the last business that we partner with to do something like that. But we're thinking about what can we tangibly do to help these businesses on a transition, on a journey towards becoming better at net zero. And part of that is around the products that we offer, and I say by working with these other organisations that can assist probably better than we as bank managers can, then we see that as adding some value to it.
Thanks, Paul. I would have thought the last comments would elicit a few questions. So anybody has a question about how they're assessed? Paul, I'll ask it. How do you score them? Is it 1 to 10?
No. It's
High, medium, low?
It's not 1 to 10. And I mean, we essentially will look at, I'll use some of the phrases that we use. We'll have a traditional farmer. So a traditional farmer that's been doing the same thing 20, 30 years hasn't particularly changed. And so we have what we class as a traditional farmer. And then, say, the other end of the scale, let's give it a better title, a more progressive farmer, so someone who's already doing some sustainable practices on the farm, be that renewables, be that on the way that they actually manage their land. And so are they already embracing some new technologies, new practices around how they do their farming? And then, I say, there's probably other bits in between those two extremes, if you like, as to what they do it. So we're not giving them a score or a number. And I say at the moment, it's for our own knowledge. It's building up the data within the banks. It's something that we've never really managed before. It's something that we've never really assessed. So we're very much in a data gathering phase to try and understand what does our portfolio look like. How do we judge them? But then, say, bringing in the likes of Leaf, and we're conscious as well, a lot of the milk buyers already sort of wanted to do these sort of audits as well. So we're very interested in getting that information into our systems as well, so that we actually have something tangible that sits behind, let's say at the moment, it's probably just our opinion. So being able to add some numbers, some data behind that to actually back up what we think of those customers is the next building block around how we do so.
Sure. Okay, thank you. Don't appear to be any more questions on this area, so I'll move on. So next one is, should farmers be relying on single enterprise advisors regarding financial matters, or should they be taking additional advice for contrast and perspective? And I think we're going to Paul.
I think, no, I was going to say the more the merrier, and that's not the right phrase, because actually you can have too many. But I think to have reliance on an individual or a banker or an accountant in isolation is quite a blinkered view in the modern world. I think having a broad range, and I alluded to it earlier when I was answering your question, having a range of quality advisors that sit around the business adds so much value, and you really do see the difference in businesses that have quality accountants, consultants, agronomists, bank managers, you name it. It's this sort of, and that comes at a cost, and sort of having quality advisors doesn't come cheaply, but it's trying to look at it around what value does that bring to the business. That is the real key on there. It'd be very easy to simply look down and say, well, that meeting's just cost me X, or having a consultant for a year costs me Y. And if they're not bringing value, then frankly it is a cost. But if you're surrounding yourself with the right people and the right quality of firms, they should be paying for themselves, and a few times over in many cases. So, in answer to the question, we would be supporting people having a lot of different, not a lot, but say a high quality people speaking to the business, rather than just simply having the one person they've spoken to for, in some cases, 20, 30 years. So.
Okay, and Roy?
I think I'll probably echo what Paul said there. So in terms of actually what we see, the businesses which are most successful, actually they will go out there to the market and they will speak to a number of advisors. They won't just rely on one person. That's actually quite a dangerous policy, because you should speak to different advisors. Valuing that advice is really important as well, so spending time with those people. So actually you need that two-way. So actually when you've got those advisors in the room with you, they need to be understanding where you're trying to get to and helping you build that roadmap. So if you're at A today and you want to be at B, then actually all those advisors need to understand where you're trying to get to. Because if they're not all on the same page as you, then you're not going to get the right advice. I think there's also a really important part which is around culture and value. One thing that I find is actually when we're working with clients, actually the best outcome is usually when you're the same-minded people. So actually if you're all actually on the same, I guess probably policy, which actually you want the right thing for the client, or the client wants to do the right thing, we all know actually what that culture and those values are, then generally you'll be speaking the same language, and then again you'll get better advice. The cost is not cheap of professional advisors. I think that's probably something to understand on day one. Whenever you're speaking to professional advisors, there is an investment there. But I think the way in which you should look at it is almost like an insurance policy. So actually, not only is it insuring you to make sure actually you are on the right track, but actually in addition to that, you're talking about many family farming businesses these days. They're multi-million-pound assets. Now, it might not be that the returns are there at the moment, but actually if you can get it right, then actually it should pay back in spades.
Okay, Elizabeth?
I don't view agricultural business or farming as any different from any other business in any other sector, and therefore I think you take the advice of the specialists wherever you can, whether that's in herd health, tax, inheritance, innovation, banking, finance. I do think that too many voices can be distracting and expensive, but at the same time I think you do need challenging. So as much as I agree with Roy with having some people that are on the same wavelength, I also agree that having some challenge does wake everybody up in the room. I think you've got to surround yourself with people who have got a proven track record and they've shown improvement themselves, not just the firm that perhaps has the biggest voice or name in that sector. And lastly, I think you can, especially where we are now, you can build your own knowledge. I realise that everybody's time is limited, but you can educate yourself, and there are areas that if you enjoy, you can educate yourself into that position.
I mean, I'll probably just round this off by saying, whatever the advisors that kind of come in, make sure there's a good working relationship there. That's probably key to everything, key for communication and key to building trust in terms of what they're saying. And it's always good to bring in specialists in specialist areas to point out your blind spots. But equally always good to have someone with quite a holistic approach as well.
Can I just to add as well, I think there'll be times in your business where there are trigger points for maybe sort of starting to look outside to see what else is there. So be that an investment, be that a death, be that a sort of looking to sort of pass things on to the next generation. There'll be points where you think, actually, now's the time where I need advice. And you might be sat there thinking, well, I'm very happy with my accountant. I've always dealt with this bank. I've always had this solicitor. You know, there's times where actually just listening to a different point of view, and it might not be with a view to sort of actually changing, but sort of hearing that other view is, you know, can be really valuable. And okay, it might be a trigger to sort of think, well, actually, do I need to consider bringing someone different into the business? But it's at those key moments that actually it's arguably the most important to think, actually, let's see what's out in the marketplace. Let's see what other opinions there might be.
Okay, thank you, Paul. Any questions on this topic area before we move on? At the back, again, wait for the mic.
It was just really, I was going to challenge Roy on everybody being on the same page, and then Elizabeth said that you need challenging, which I agree with. Because I think that's the role of an advisor, is it really? To be on the same page, but for challenge to happen.
Yeah, sorry, I'm misunderstanding. So I'm in terms of the same page in terms of actually understanding where a client wants to get to.
Okay, that seems to have answered that one. Okay, final question to pose. How can farmers more appropriately allocate profits to improve efficiencies within the business? So start with Matt.
Yeah, well, I suppose the obvious one at the moment, within reason, is allocating as much profit that you can to reduce overheads. And the obvious overhead that a lot of people are trying to reduce at the moment is reliance on staff. Right? And I'm not saying everyone should go running into robots tomorrow, but I'm saying, you know, there's a lot of stuff that could be done, you know, automatic cup removers, automatic drafting gates, cow collars, all those sorts of things that will provide you with more data about where your herd and other areas on your farm where everything is at, with less reliant on a whole load of humans trying to do the same job. So that's an obvious way of doing it, and certainly technology is a way forward to invest in to increase efficiency.
The way I interpreted this question was that I think that to get the efficiencies, you need to understand enterprise management, so that you understand each facet of your business, which even if you think you're the most, the simplest form, which is just cows, forage production and young stock, knowing your enterprise costings, I think, is key. And then, of course, you get into the more complex businesses where you need to know on arable property, renewables. Most softwares have this functionality now, and they're all pretty much easy, relatively easy to run. I would say a good bookkeeper is worth their weight in gold, because rubbish recording is rubbish reporting, and you then also can retrieve the information yourself with confidence. And have a set of rules when you are inputting, so that everybody has the same standard, so that you're getting some proper enterprise management accounts out, whether that's on a monthly, quarterly, or annual basis.
Yeah, I think enterprise reporting is really important. And again, there's a number of ways to interpret this question, but I think the first thing I thought was this about enterprise reporting. So actually, if I take, for example, one of our clients that's actually really focused on making sure that each enterprise is profitable, then, for example, they've got a property portfolio, so they run a P&L for their property portfolio, they run a P&L for their AD, they run a P&L for their arable, they run a P&L for their grass production, they'll then have their calves, they'll then have their heifer, and also the milk production as well. So they monitor each one, see actually what's going well and what perhaps they can improve in those areas. The other aspect in terms of actually what they're doing as well, we're seeing is actually in terms of those business structures. So actually, for clients that actually are probably in a position whereby actually they might be either under cash flow pressure, or whether actually they're into cash flow surpluses at this present time, if you understand actually which enterprises are generating those cash surpluses or under pressure, then you can look at the business structure. Now that can be for capital tax planning, that can be income tax planning, and various other aspects. But actually, when you've got that raw data, you can sit down with your advisors, whether that's your tax advisor or your consultant, or yourselves, and just go through that data and actually see, actually, is there some tax planning that we can do here within those enterprises, whether that's partial incorporation and looking at putting certain elements into a company, or whether actually that element of the business actually is part of a succession plan. Is it that part of the business actually could bring another generation in, and actually another part of the business is for another generation, therefore you can divide the business up into different structures.
Just picking up on something Roy said there, and concur with all his points. The best businesses and the most successful businesses that I work with are the ones that are looking for those constant improvements. So I think of one case in particular. You know, they probably haven't had their most profitable year a number of years back. And the meeting I had, they'd been the most critical of their operations. They'd looked at exactly what they can do to change their efficiencies. And in this business, as with a lot, it's fine-tuning. It's not a revolution, but it's quite easy, certainly in profitable years, to sort of take the foot off the pedal a little bit and think, well, actually, yeah, you know, we're making good money this year. Things are good. Whereas actually, their approach was, well, you know, now is the year where we can actually look to make some tweaks. We can look to make some changes. And so it's that restless curiosity, if you like, to actually continue to get better, because, you know, their view is that they'll never be perfect. There will always be something else they can do. They can change and sort of approach differently. And actually, that's a lot easier to do when you're coming off the back of a successful trading year than actually when you're actually maybe tight for cash, when the milk price hasn't been in your favour, thinking, what do we do now? Do it when times are good and not just when times are bad. Finally, say I'll refer to a previous answer. You know, if you're looking at, you know, what can you use profits for to drive efficiencies? I'll go back to advisors again. We've talked about it already, but actually take some time to invest in the right advisors at that point in time when you've got perhaps some spare cash flow to do it. You know, is an ideal time to think about that as well. And I'm conscious there's a couple of accountants in the room, but actually, having a little bit of a war chest, a little bit of cash set aside, if you do make a profit, isn't the worst thing in the world, because almost inevitably at some point you might need it. And it wouldn't be nice now and again not to have to phone your bank manager and have it yourself, but I'll leave that to you.
Okay, thank you, Paul. Question on the right. Just wait for the mic if you would, and we can hear the question.
Hello. As there's been a change in government at the moment, and there's a new budget imminent on the 1st of October, and they're talking about inheritance tax, where a lot of farmers have bought farms at a very expensive price within Shropshire that I can tell you about. And if this is going to affect inheritance tax, where I've had advice from an auctioneer who said we're a farmer, the average age of a farmer at the moment is about 60 years of age. And so if the inheritance tax was to affect any farmer in that situation, there's no alternative but to sell the farm. And basically, what I'm trying to say is that will the land values come down as a result of that? Because, you know, when you've paid a lot of money for a farm and you in the banking industry are lending the money and the land values come down, how are you going to deal with it?
Sounds like a question for Matt and Paul initially.
Yeah, I mean, I'll probably start by saying in my relatively short working life, I've seen land values devalued by 20 to 30% due to reasons other than inheritance tax. So I've seen land values in other parts of the world that have dropped literally 20, 30% overnight, mainly due to commodity cycles and actually the availability of credit post global financial crisis as well. So look, I mean, the land market's a funny one, and it's a free market, of course, and you never know what is going to happen. But I would say, and I'm not going to predict, but I would say, given the amount of money and everything that is sloshing around in this economy in particular, and I alluded to earlier with the other sort of activities that can happen on farm here, not just farming. So the utility value of UK farmland is that much higher than most other places, most other culturally similar farming economies in the world. That will, along with your population growth here of 70 odd million people in such a cramped space, I just cannot see it. It may happen, and I may be completely wrong, but due to all those factors, utility of land use, population pressure and population growth, and the continued need for food, British food hopefully, I just think that's going to uphold land values.
Okay, Paul?
Yeah, I suppose what I would add to that is when we look at the money we lend against the security that we have, and so the value of the security, we obviously have a fairly clear view in our books as to what that looks like. But when we look at farming, we lose very little money, and we don't lose very little money because we've got that security. It's quite seldom that we have to rely on that security to pay us out as a bank. We don't lose much money to lending to agriculture, and I think I would talk for all banks here, not just HSBC, because we're lending to quality people operating in a quality industry that repay us. And there'll always be anecdotal scenarios where we did have to sell the farm, but they are few and far between. So would a drop in land values actually change our appetite? I don't see it, but to back up what Matt says, I also don't see this falling off a cliff, even if Rachel Reeves decides to throw a few grenades over the fence.
Okay, Roy? Yep.
I think there's a lot of noise around the inheritance tax release, and there's probably some work being generated out of that. The inheritance tax release for farming businesses are not solely hinged on agricultural relief. There's also business relief there, which also provides 100% relief if your business is structured correctly. I can't see a government removing business relief. That would significantly impact a large part of our whole economy. So I would suggest that actually if agricultural relief is abolished, then that will impact perhaps more of the investors. But actually in terms of the business structures though, if it's the case that you can restructure your business to secure 100% business relief, then actually you'll get around any change in legislation. Now the only thing that's going to impact probably is let farms and farmhouses. Now will they go after farmhouses? Maybe they will, but I'm not sure they're going to make any fundamental changes there. Famous last words, but I'm not sure they will. And if they do, then speak to your advisor, because there might be a way around it with lifetime giving, whatever it might be, trusts or business restructuring to facilitate negotiating and navigating those changes.
Anything to add? No. Okay, got time for another question if there's anybody wanted to raise one. Can't see any hands. Oh, I can now. Wait for the mic.
I'll soon be having my annual review with my bank manager, and before he arrives he'll want a few figures so he can see. Can the panel just help me out and tell me in 12 months' time what will my pence per litre be?
Who's going to take that one first?
What system are you on?
Semi-New Zealand.
Milk contract?
Leprino.
40p.
No, sounds like no change.
If it's 40p, Chairman, you started with this session saying that the cost of production is 44.
Yeah, based on quite a lot of analysis now.
Could we have a comment off the panel about that then?
Just as a caveat, that's the average. Range of cost of production is probably plus or minus 8p a litre. So the best at minus 8. So better quarter at minus 8.
So on average, dairy farmers are expected to lose money next year then?
That's historic. He's talking historic. You're talking forward pricing.
Yeah, I'd also be talking forward as well, though. Cost of production is pretty static. Not really shifting. Bit of movement on feed price down, energy price maybe, but most other costs are still inflating. So it's a pretty tough outlook. But over to Paul to start with.
Yeah, I mean, I'm not as good as Elizabeth as working at. I'm not going to give you a number like that, but all I would say is that we've been here before where cost of production has been above milk price, and that's why these meetings with your bank manager, I'm sure you all look forward to them, but that they're actually really, really important, because us understanding your business, understanding where you are, should mean that we can make sure that you've got the right facilities to get you through to the next annual meeting at the very least, and hopefully along a strategy than that. In my experience, most banks that are lending into this sector want to continue to support good quality customers, and we're talking about market influences that are outside of your control here. So as a lender, if we've bought into you, we like what you do, we think you're good at what you're doing, actually fluctuations in the market we can live with. But having that open line of communication, speaking to them early about what your concerns are, how you see it, is absolutely crucial in making sure that we're there to back you and make sure that you're there to get through.
Anybody else like to, Matt, perhaps?
Yeah, I mean, it's probably what I'll say. If you don't understand the fluctuations in milk price in this market, particularly as a bank, then you probably shouldn't be there, right? So that's the first thing. And when we lend, it's a combination of, generally, if you're an established enterprise, it'll usually be an average of the last 3 years' worth of profitability from your accounts, assuming there has been no change and they've been sort of 3 normalish kind of years, and we'll be projecting forward kind of 12 months as well, as a general speaking. So that kind of flattens out those dips, right? So if the historical last 3 years performance has been sound, you're going to get the odd dip every like I said, I think every 8 years we tend to get a good dip, but that's just the reality of this market that we are working in. There's going to be some years where it's going to be difficult to turn a profit, but other years are going to be profitable, and that's just, you've got to draw a line in between the highs and the lows and work out that midpoint, and that is the art of ag banking.
Okay, perhaps just to finish, I'll ask each of the panellists to give us one take-home message for our audience here today. Matt, if you're happy to talk.
Yeah, look, I suppose I'll just say to everyone, focus on what you can control, and focus on cost of production and carbon audits. They're probably the 3 things that I'm hearing the most in my world, and probably with the benefit of hindsight of seeing. I mean, I'm still pretty green in terms of my working life, but I have seen a couple of commodity crashes at the front line, and I've certainly learnt some lessons from it. But control what you can control. Take a long-term view, and the environmental side of things. It is here. It's going to be slow. It's going to evolve, and for those that actually get on board with it quite quickly, there'll be some definite reward.
My take-homes are communication and control. So do everything you can to know exactly what your business is doing, and use all the resources you can to get to a better place.
I think probably for farming businesses, actually, the future is actually going in the right direction. It's a bit bumpy at the moment. And with that in mind, I think it's actually focusing on where you want to get to, and investing your energy on things that you can influence in the future, rather than actually worry about things in the past. You can't change the past, so focus on that future and that vision. And actually with that as well, working with your advisors to actually make sure you're getting good advice from your consultants, your bank managers, your accountants and your solicitors, to make sure actually everyone is actually got your business structured in the right way to facilitate tax planning, but also succession planning to take it forward, so that you actually are on the right track to where you're trying to get to.
Right, well, all of mine have been stolen now from you 3. I was going to say communication. It's about speaking to the people that you work with, speaking to yourselves as families, as businesses. Absolutely key that you have that open lines of communication. But to pick up Roy's points, HSBC's view of the sector is a positive one. We have huge appetite to back good businesses within the sector, and that's not because we're looking to make a quick profit or anything like that. It's because we have a genuine belief that the future of farming is a bright one. That will inevitably mean some evolution. It's not a case of standing still, but the right businesses that are looking to the future are there, and there'll be finance for them.
Okay, that's the end of the session. Thank you all for attending. Thanks for your questions, and I wish you enjoy the rest of the show if you're not travelling home. Thank you.